Hi everyone, welcome to another edition of Wallet Max Planet Positive podcast. I'm Bhuva Shakti, based in New York and the founder of Wallet Max. We are a global community of startups, investors, and executives focused on increasing sustainable funding access, especially in climate tech, fintech, deep tech, and AI sectors. We interview one investor every month for our podcast. We invite them to share their background, but more importantly, what differentiates them from the crowd? How do they prioritize impact along with profits and people? We deep dive into their personal and professional journeys and their mission to uplift. Today, we are speaking with Sarah Morgenstern, an investment partner at Flourish Ventures. Flourish is an $850 million global early stage venture firm that backs entrepreneurs transforming financial systems for the better. Flourish believes that the most valuable fintech companies solve foundational challenges, expanding access, improving products, lowering costs, allowing people and businesses to thrive. Previously, Sarah was a principal for direct investments at Omidyar Network, and prior to that, she was a manager at McKinsey Company. Sarah was also a Kauffman Fellow and was named a 40 under 40 Rising Star by VC Journal. Let me now hand over to Sarah and invite her to say a few words about her background and career path. Over to you, Sarah.
Well, thank you so much for having me on. I'm really glad to be here with you today. One of the questions that we chatted about to kick off with was sort of what a defining moment in my journey had been from McKinsey to Omidyar to Flourish, and how that's changed how we think about financial systems. So I thought maybe we could start there. And I think the biggest shift in my career has really been moving from thinking about optimizing individual companies to reshaping systems, right? So at McKinsey, the goal was relatively straightforward. You want to help financial institutions become more profitable and more competitive. At Omidyar and now at Flourish, we've expanded that lens to understand how technology, capital, policy, media, consumer behavior, how they all interact to shape financial system outcomes. And I thought I'd share just a couple of moments that really crystallized that shift for me. The first shift was redefining the goal of the system itself. So when I joined Omidyar around a decade ago, the dominant conversation at that time was still around financial inclusion and access. But coming off of the 2008 financial crisis, it was increasingly clear access alone was not enough, right? You could have widespread access to checking accounts and credit cards and loans, but if those products were poorly designed or extractive, the outcomes could still be bad. And at the same time, there were groups like the Financial Health Network and the CFPB that were shifting the conversation towards financial health and well-being as our real system North Star, right? So much more outcomes oriented. And that framing really changed and continues to shape how I think about success, that the goal is not just getting more financial products in more hands, it's a system that is genuinely helping households better manage day-to-day needs, build resilience, and improve long-term outcomes. So that was one major shift in thinking. And then the other second shift, or sort of aha moment, came a few years later, and it was appreciating how infrastructure shapes outcomes as much as consumer apps, right? So when I joined Venture in the mid-2010s, there was this remarkable wave of consumer fintech innovation enabled by mobile distribution. And at Flourish, we were fortunate to back companies like Chime and Propel early that were using technology to serve mass market consumers in really innovative ways. But when we later reflected on our anti-portfolio and sort of stepped back and said, all right, what did we miss, right? One of the obvious misses was Plaid. And I think at first glance, Plaid sort of looks like a B2B data infrastructure player, not necessarily part of the financial health innovation story. But in reality, that was the data plumbing that an entire generation of fintech companies sat on top of and needed to scale. So I think it's a great example of how you have to sort of modernize the plumbing and the back end in order to unlock innovation on the front end. And that's really continued to be how we think about this at Flourish moving forward.
Yeah, no, couldn't agree more, especially the financial crisis. It's not about investment banks and Wall Street and trading platforms anymore, right? Because so many people, general public who had no involvement or idea of what's going on inside these investment banks had to struggle. So, totally agreed with your approach where we need personal finance and consumer health to be at the forefront, because when the consumers are flourishing, obviously businesses will get more customers and obviously business can thrive. And I remember the early days of Plaid as well, because I mean, originally it was more like a dev platform with some coding here and there, more about data. But later, if we see today, almost many fintech companies, including traditional banks, rely on Plaid, right? So it's really critical. So couldn't agree more on that. Now
Yeah,
you've operated, yeah, you've operated across consulting and investing, right? So sometimes they are kind of, contradicting each other. Sometimes they are so tied to each other. As an example, if someone goes into consulting, then they are transitioning into investment bank or venture capital and vice versa, right? So, what's your secret sauce today when evaluating early stage fintech companies having both consulting and investing backgrounds?
yeah, it's a great question. And I wish there was a secret sauce. If there is, I am definitely still searching for it. But I try and harness the best of both the investing and the consulting backgrounds. And there are really two dimensions that I focus on in particular. The first is around founder market fit. What is it about this person's background, their insights, their lived experience that lets them see something that others have missed? I think the best founders usually have some unfair insight into customer behavior, market structure, distribution. And sometimes that comes from their professional experiences, sometimes they're personal, sometimes a combination of both. One example in our own portfolio that immediately came to mind for me was a woman named Jules Muir. She's the founder and CEO of a company called Vellum. It's an AI native insurance infrastructure company. And Jules has held leadership roles across multiple parts of the insurance ecosystem, including reinsurance, specialty carriers, MGAs, and consulting. She's worn a ton of hats. And as a result, she understands sort of the incentives, the pain points across the value chain, and also can speak the insurance language, right, to the buyers, which is not easy to do. So I do think that that's an example of sort of deep domain context that is a genuine unfair advantage. That's bucket number one, is sort of that founder market fit and unique insights. The second is more a top-down system structural question, which is where are there big, deeply entrenched inefficiencies where tech can help to drive down costs or expand access or improve the customer experience. And I think some of the most compelling opportunities are not always in the flashiest categories, right? They can also, like just these behind the scenes operating pain points. And so a good example there to me is a company in our portfolio called Reserv, which operates in the insurance claims processing space. Not an obvious trendy topic, but it is a huge market. Insurers spend billions of dollars a year managing claims. A lot of it is manual, it's legacy software, and the customer experience is awful, right? Claims consistently generate some of the lowest, right? We all know this person, we've all had the experience. I don't even need to say anything more or elaborate, right? But it's got the lowest NPS scores across financial services because you've got people who are interacting with insurers at these stressful, high emotional moments that matter so much. And then they're bumping up against a system that's like slow and opaque. So with Reserv, I think they also had really deep operational understanding around the bottlenecks in how claims actually get processed, and how modern infrastructure and especially AI could improve outcomes. So some of the biggest opportunities I do think are at that critical infrastructure layer, and most users don't see the software their claims processors use, but man, it makes a difference in their own journey.
Yeah, no, definitely. Especially the claims process that you mentioned. Sometimes I've seen so many people, including me, where if it's only a few $100s, I mean, I don't want to go to the system and do all that follow up and work. I'll just let it go, right? And that's happening so frequently. And founders who are trying to identify some of these pain points, where I have noticed also is when the founder has had a personal challenge or someone close to them, or they see this every day and people are looking for a solution, the founder market fit is amazing when it comes to that. Yeah, definitely. And so at Flourish, you focus on transforming financial systems. So, what does that mean in practice beyond the traditional fintech narratives? Because, like you mentioned, there are these huge insurance companies, financial firms, both in US and globally. Like they cover almost, let's say, 80% of people living on the planet, right? So, what does that mean?
That's a great question. Um, for us, transforming financial systems starts with building genuinely great businesses that are solving end user problems at scale. That's got to be true. We want our companies to succeed on their own merits and become real market leaders. But we also think that the most important fintech companies can do something bigger than that. They can change how the broader system behaves. And the way we think about it is that real system change happens when a company is so successful that incumbents are forced to respond. I think Chime, the mobile bank, is a great example of this, right? So Chime did not just create a successful mobile first banking product, it also sort of fundamentally challenged the idea that banks needed to rely on punitive overdraft fees or minimum balance requirements as core revenue drivers, right? So Chime built simpler, more consumer-friendly product, but it also created real competitive pressure on incumbents. And that mattered beyond just Chime's own customer base, right? So combined with policy and regulatory shifts, we saw that the challenger bank competition really helped push a lot of incumbents to reduce or eliminate overdraft fees altogether. And that sort of system-wide billions of dollars in annual savings. And that is sort of the culmination of systems change, right? Is that you built a really commercially successful company, but it also had ripple effects and changed incumbent behavior across the board.
Yeah, no, exactly. Especially the concept of chime that you mentioned, it also enhances the earlier concept you mentioned about financial well-being and consumer health, right? So, in several studies, we see data either doesn't exist or broken data or incorrect data in the traditional systems that was not letting many people to get access to the financial system, even to open a bank account, credit card, or try to operate on a daily basis. But chime kind of companies not only, like you said, broke the narrative, but also forced the incumbents to be more inclusive of people and be more included in the financial system itself, right? So that's a great narrative. Now, what are the most broken parts of today's financial systems that founders are still underestimating? Because when we talk about financial systems, some people call insurance very separate from the traditional banks. Sometimes they combine it together. So, what is your thought process? And if I'm a founder, what am I underestimating?
Yeah, there are so many potential good candidate answers to this question. And I think you're right to call out that insurance is probably an important example of a space that is sort of underappreciated in its impact on customers and on its potential for transformation. And we've been betting heavily there. But another sort of stressed piece of the system, maybe not the most broken, but fraud and scams actually is one of the first things that came to mind. We've seen AI dramatically increase the speed and sophistication of financial crime. And I think people do underestimate how systemic the problem is becoming, right? Fraud is not just sort of a cost center cordoned off over here. It is effectively a structural tax on the whole financial system. And the real danger is if consumers stop trusting digital financial products because scams become so pervasive, that slows and undermines the whole system, right? So we can only sort of harness the upside of digital innovation if we also ensure that we're keeping the system safe while we're doing it. So we spend a fair bit of time thinking about modern trust infrastructure. We've got companies in our portfolio like Alloy, Spade, Tunic Pay, Cipher Owl. They're all tackling different parts of that challenge, from identity verification and transaction intelligence to scam detection and digital asset risk management. So a host of sort of financial innovation focused on, how do we push back against this big wave of scams and fraud that's coming on board? And then interestingly, it's not just a technology problem, right? One thing we believe strongly at Flourish is regulators, ecosystem stakeholders, they all need to be a part of the solution as well. And so at Flourish, we actually support broader industry and policy efforts that are focused on scam prevention. So for example, the Aspen Institute has a national task force on fraud and scam prevention that it's brought together. And we think that kind of coordination across different stakeholders, financial institutions, tech platforms, policymakers, consumer advocates, is an important complement to technology-led innovation to address the issue overall.
Yeah, there are two schools of thought, right? With AI, obviously you can identify financial crime and fraud maybe a little bit better and faster. But then we see bad actors using AI to do more of those crimes and frauds, right? So I see so many people getting these scams from traditional banks, from fintechs, that they are kind of not able to trust the system, right? So, and it's not only in US, I think it's everywhere globally, and you also invest globally, right? So how does your lens change when evaluating fintech in the US versus emerging markets?
Yeah, I love this question. There's actually a lot of things that stay the same. I should say that first. But one common difference is in the US, you're often unbundling and rebuilding around legacy incumbents. And in emerging markets, you're sometimes building foundational infrastructure more from scratch. There's just more greenfield. And so you're sort of solving first order problems around payments, savings, credit access. So merchant acquiring of all spaces, I think, is an interesting example. In the US, merchant payments infrastructure is pretty mature. And so the innovation there is usually like at the software layer or embedded finance. But in many emerging markets, the payments infrastructure itself is still unreliable, right? Payment acceptance is inconsistent. Settlement can be delayed. Uptimes can be poor. And you've got sort of SMB and merchants that are juggling across a lot of different providers, and that creates real pain for SMBs. Because if payments don't work reliably, you can't do your business reliably, right? So we've invested in some companies, Akua in Colombia, in Latin America, Little Fish in South Africa. They're both tackling the sort of merchant acquiring infrastructure gap. And we're seeing that they're directly driving up authorization rates, increasing settlement speed and uptime. And I think once you've stabilized that core payments layer, then there's a lot of things you can build on top of it, right? Then you can do lending or cash flow management or other kinds of embedded finance. So it's a really foundational piece to strengthen, upon which a lot else can be built out.
Yeah, exactly. You don't have to rely on those one or two networks to do any transaction in the world. And that's what I have seen, especially I do also work with a lot of climate and fintech and AI companies within the climate space also. You mentioned there's a lot of greenfield in emerging markets, right? So here we are trying to see how the existing grid infrastructure can accommodate new types of energy, whereas in Latin America, Africa, and India, you have clean energy from scratch, meaning solar and wind and other renewable energy sources, because they never had a lot of electricity in the first place. So it gives so much innovation to come up, but also it's cutting edge, right? So really, I do follow quite a lot in the emerging markets as well. So yeah, couldn't agree more. Where innovation is a little bit farther ahead than us
Yeah,
here, because we
no,
have
it's
to work
really
around the
progress in many ways,
yeah
totally.
yeah, we have to work around the traditional systems. There's so much time that takes to transition and things like that.
Right.
Now, when it comes to financial inclusion,
Huh?
there are a lot of definitions around this. People want to call it financial inclusion, but are they really doing it? But in some cases, people may not call it as financial inclusion, but they are focused on the financial well being of people. So, I would like to hear your definition of what financial inclusion means, and where do you see real innovation in financial inclusion that goes beyond the surface level access?
Yeah. So we tend to think about expanding the aperture to think about that outcomes oriented definitions of financial health, financial well being, which is sort of day to day systems that help households to better manage risk and seize long term opportunity. Um, and I think when, with that as the North Star, the shift becomes not just can someone access the financial system, but once they're in it, does it really work for them and help them to accomplish those outcome goals? So, cross border payments, for example, I think is an interesting notion of this. You know, you've had decades of digital advancement. But money movement internationally is still pretty slow, pretty expensive, pretty inefficient through a lot of corridors.
Yeah.
And that disproportionately impacts migrants, SMBs, coming back to our emerging markets discussions, companies operating across emerging markets. And so that's an example of a problem that is not just about access, but it's also about how much does it cost me to do this? And how painful is it for me to do this? How much of my time and mental bandwidth does it take for me to move money to my family overseas? Um,
Yeah.
and cross border, I think, is one of the places where stablecoin and other digital settlement rails really are starting to address some of the operational problems there. You know, right now, our general sense is it can cost 5 to 10% of the principal for somebody to move money to some of the lowest volume corridors. And we can see a world where stablecoin based payment infrastructure can compress those economics pretty meaningfully. So a world where you could drive that down below 1% over time while also giving the consumer more transparency. Like, where are we in this process? When is the money get to my intended target? And let things settle more quickly 24/7. So that, I think, is one example of where it's not just surface level access. It's once I have it, am I able to accomplish what I want to quickly and transparently and affordably across markets?
Yeah, definitely. And I mean, I go through this almost every other week also. So I work with an organization that's headquartered in Paris. The
Mhm.
customers are in US. They want to pay, send money from here to there, and they need to send few things from there. So much money is lost in just the transfer, right? So
Right.
$100 from here goes to the Paris bank account as even 95 euros or 80 euros, depending on the exchange rate, but so many fees, takes 5 days. And then when you have to send something in US dollar, the same $100 is almost equivalent to 60, $70 here. It's all gone in the exchange fees, not necessarily the exchange rate also, right? So the stablecoin approach that you mentioned seems very promising. But how would someone like me or regular people know about this, learn more about this, and solve their pain point? Because even last week I went through some a similar problem of losing $50 just in transfers.
Yeah, I think we're still early in sort of broad-based awareness and adoption of some of these technologies. That said, it's accelerating pretty rapidly. And so, for
Mhm.
example, we have a company in our portfolio called Crossmint, and they're partnering with MoneyGram to enable stablecoin payments. So I do
Mhm.
think there's a world in the relatively near future where some of the biggest names in cross-border money movement are the ones themselves saying, "Hey, here's an alternative way to do it." And then it's also a space where we could envision a lot of word of mouth. This should be the
Mm.
kind of space where the difference is so day and night that once you use it, you're telling your neighbor, your friend, your family, like, this solution is so much better. So I do think it's a space from a D2C standpoint where you can see sort of virality in terms of distribution.
Yeah, no, totally agreed. Like, if I know that this works, I'm going to tell all my friends,
Right.
so that's going to be the approach. And also, like you mentioned, if the traditional players think that this is the way that the consumer demand is moving to, then that's also going to give us that network effect in terms of
Yes.
scaling the approach, right? Yeah.
Yes.
Now, Flourish has an evergreen structure. So, how does that change how you think about time horizons, risk, and returns?
Yeah. So, as you mentioned, one thing that's unique about Flourish is we have this evergreen structure. So, we don't operate against artificial fundraising or exit timelines in the way that a traditional firm might have to do. We are not managing towards a fixed fund life cycle where we need companies to raise, on a certain cadence or pursue liquidity within a predefined window. Uh,
Mhm.
and I think that creates opportunity for healthy alignment with founders. So it lets us keep the conversations with founders focused on exclusively what is best for this founder and this company at this stage in this set of market dynamics. And that shapes when should we raise, how aggressively should we scale, how do we sort of balance growth versus efficiency, navigate market cycles, all of those conversations. They're still very challenging, difficult, complicated, but we're able to come to it from the perspective of the founder and what's best for that long-term growth. And then the second thing is it lets us be a little founder centric in how we show up in syndicates, and more flexible around sort of how companies choose to build over time. So those are some of the differences that I would call out in terms of what that structure means for our day to day.
And it seems very founder friendly also, because I know a couple of founders who were doing really well. There was a lot of growth and revenue traction. They were doing, diligent expansion into new countries, new markets, and things of that sort. But the venture capital fund had an exit horizon that was coming up. So they rushed into entering into a new market without doing proper diligence, and it did not go really well, right? So they had to rethink so many things. But I think with the evergreen structure, it's more founder friendly, but also you see the market opportunity and adjust as needed. Less pressure, but still the same returns, I guess.
Yeah, I'm I'm sorry to hear that. And yes, I think you're right that it's around sort of keeping incentives aligned, but very much still driving towards a commercial return outcome for everyone involved, right? That remains absolutely and unquestionably our shared goal with both our founders, and all of the investors sitting around the table. It's the best path to get there and making sure we're choosing that thoughtfully.
Yeah, win-win for everyone.
Right.
So, can you share an investment? So, we've heard a lot of success stories, but obviously, all of us, including myself, go through some of those painful moments. So, are you able to share an investment that didn't go as expected? What were some learnings, and how did it shape or reshape your decision making?
Yeah, great question. Because venture is not all up and to the right all the time, no question.
Yeah.
Um, maybe without getting into a specific company, I was thinking back on some of the biggest lessons from the last wave of fintech and insurtech. And a lot of it, I do think, comes back to sustainable unit economics. So, on
Mm.
consumer fintech side, one lesson is just how hard distribution and trust are, especially when you are competing against extremely well-capitalized incumbents that have big brands and existing customer relationships, right? You need an unfair advantage in your go-to-market, and whether that's messaging differentiation, embedded positioning, unique partnerships, there's got to be something that fundamentally bends the customer acquisition equation in your favor. I think that lesson was probably even sharper in insurtech. So insurtech is a category where top line growth can look impressive for a stretch, even if the underlying underwriting is weak. So one of the things I think a company in our portfolio, Kin, which is a digital first home insurance company, did quite well is actually stay disciplined about loss ratios and risk selection from very early on, rather than just optimizing for gross written premium growth rates. And that in the short term can sometimes mean you're growing slightly less quickly than a competitor. But I think over the long run, the companies in insurance that really treat it like a risk business and not just a software business prove more resilient. And I think we've seen the public markets reward insurance companies that are really putting unit economics front and center over time.
Yeah, I mean, I couldn't agree more on the unit economics, especially also when I talk to so many founders. I talk to them about fundraising, product operations, scaling, growth. Everyone has these big circles of TAM, TOM, SAM, SOM, but unit economics is something not many founders pay attention, at least in the early or seed stage. But it's really important, not only for the investors, but even for them to see where their company is headed, right? So, I mean, I talk about it all the time. Couldn't agree more.
That's really well said.
Yeah, yeah. And in addition to, let's say, unit economics, what other signals tell you a fintech founder truly understands the customer problem versus just the product?
Yeah, I love this question. I think especially in fintech, it is they understand the customer's life and sort of where the financial moment or transaction fits into it, not just the product. And they get the emotional context, right? Like so often financial products are meshed up in embarrassment or fear or stress or uncertainty. And so I think founders that really get the customer's life and not just the interface, and that really understand the emotional tenor of the product, which I guess sort of comes back to empathy and curiosity, if you had to boil it down. The founder that immediately came to mind when I thought about this was Jimmy Chen, who's the CEO and co-founder of Propel, which is a cash flow management app for food stamp recipients. And he's always really exemplified this, and sort of starts with a deep understanding of the lived experience of low-income Americans and how they navigate the benefit system. I remember when we first started chatting with him, he and his team had literally done grocery store ride-alongs with food recipient to sort of understand what that shopping experience was like. Where were the anxieties? Where were the friction points? And it was in doing those ride-alongs that he noticed, people are, to check their balances, to know how much they have available to spend, they're having to call a 1-800 number and sit on that phone for a while, right? It's not instantaneous. And the result is, if you don't know how much you have to spend, moving through the grocery store is really anxiety producing because you don't know if you can afford that additional gallon of milk. So that was one of the initial ahas that they had, which was, hey, if we could help people know real time their balances, that will really improve their shopping experience. So that's one example of how staying close to the customer helped them come up with what was really sort of a killer first product idea. And then I've also been impressed through the years on how they think carefully about things like limited mobile data plans or intermittent connectivity, sort of other aspects of their target customers' lives that shape how they approach and design the product, for sort of the real constraints and emotional realities of their customer base.
Yeah, calling that 1-800 number and staying online and still not getting an answer. And if
Exactly.
you're working in shifts, you're losing out on your work hours. And it's such a big pain point. And I mean, that's really true, right? So if you understand the pain point, solve the customer experience, then your product is going to really do well and can expand into other territories. But many times founders are so embedded in a very shiny, polished, perfect product that they may lose the customer experience in the journey, right? So
Yeah.
that's really important.
Yes. And I
Yeah.
think becoming even more important in the AI moment as everyone wrestles and grapples with what are sources of defensibility or where is there a moat, really deeply understanding your end user and having a unique customer insight about what to build and why to build it is going to become every bit as important as building it, because the building is becoming
Yeah.
commoditized.
Yeah, no. These days you hear AI powered, AI enabled in everything, almost everything. I can't even say most things, right? But yeah, the goal is to solve a customer pain point and maybe use AI to make it more efficient and effective, both for you as a company and the customer, versus I have to do something with AI and then trying to do something is
Exactly.
really, yeah,
Backwards.
not going anywhere. Yeah. Yeah. Now, how do you evaluate trust in financial products? We all know money is a really, more emotional thing, not only for individuals, but for companies, countries, anyone in the world, you name it, everyone has some kind of relationship with money. So, how do you evaluate trust in financial products, especially when serving vulnerable or first time users, right?
Yeah. We touched on incentives earlier, and I think those are profoundly relevant here as well. So, starting with asking, like, are the incentives for this product and company aligned with customer success is one set of questions that we look at here. I think that the business model often tells you a lot about whether a company is incentivized to help the customer or ultimately be more extractive. And so that's part of why at Flourish we developed a set of fair finance principles. And the idea is that financial products should be transparent, understandable, responsibly designed, along with good outcomes for customers. And that sort of helps to guide how we evaluate companies when we're looking at them and ask questions around, okay, do people actually understand what this product is? If you're a
Yeah.
customer, would you get what the fees are? Are they transparent? So I think big picture, in financial services, there's the old adage of trust compounds slowly and disappears quickly. And I think that's very true. And vulnerable users are often, I think, incredibly rational and discerning in being skeptical of new products because of the experiences that they've had. And so being really thoughtful about the business model is an important component of helping to build trust over time.
Yeah, and trust is becoming very important beyond financial products in everywhere today, that we see, right? Both in US and in the world, especially also when it comes to policy, media, research. All of this is also trust based, or people are looking for more trustworthy sources, materials, and products. So,
Yes.
how are these shaping the next generation of financial services companies?
I really love that insight around how these broader set of stakeholders are also um, challenged to establish
Yeah.
this time. Um, I think one thing we believe strongly at Flourish is that financial systems don't change through technology-led startups alone. Those are
Mm.
really, really important, and that's the core of what we do. But we also believe that policy, research, media, they all shape the environment in which innovation either accelerates or stalls. And so maybe to break that down into a couple of component pieces on the policy side, our starting point is, look, financial services is highly regulated for a good reason, right? It's people's money, it matters. And so the question is not whether regulation will matter. It's sort of, can policymakers and innovators evolve together constructively? And so we support ecosystem organizations like FinReg Lab, which helps to create evidence-based frameworks around emerging technologies and financial innovation. Basically, help regulators themselves build out the evidence base so that they can make informed decisions and weigh the relative merits and risks of new innovation. It's also why we've been longstanding partners with Joanne Barefoot and the leaders at AIR, which helps regulators themselves sort of modernize how financial oversight works, and think about how they can use technology in their own day-to-day in order to improve the efficiency and efficacy of their own work. So that's one big component, is sort of policy. Your other point on media being increasingly important too, I think is critical, because financial behavior is so shaped by narratives. We all have beliefs about money and debt, investing and financial opportunity. And a lot of that increasingly does come from creators and social media and podcasts and entertainment. So that has to be a part of the story of how you sort of help a system move in a positive direction, because they're so consequential. So that's part of why we have a media and money strategy where we support and partner with entrepreneurs and creators who are sort of helping to shape healthier, more inclusive financial narratives.
Yeah, I mean, that's a great initiative, I think. Yeah.
No, it's been incredibly interesting, and we feel so privileged to work with all these wildly creative folks. The last piece, just to quickly touch on, is research. We invest in research at Flourish because it helps to identify where are households and small businesses struggling, right? Where are markets failing? Where is new infrastructure needed? And some of our strongest investment themes through the years have come from stepping back and asking those broader structural questions through research about financial health, trust, fraud, access to capital. So those are how we see the different components of the ecosystem all being critical. And so hopefully this combination of 1 + 1 = 3, that backing extraordinary companies and then partnering with broader ecosystem players, all helps to improve the system for the better.
Yeah, no, exactly. It's not about just focusing on startups and investors. Press, media, research are really critical, especially in this day and age,
Yes.
to kind of get the message and narrative for the
Right.
consumers, right? Yeah. Now, we touched upon AI a little bit a few minutes back, but AI is also rapidly entering fintech, including many other sectors, right? So, where are you seeing real value creation versus noise?
Yeah. At the highest level, we've seen over the last decade sort of the mobile first wave play out and make finance simpler, more accessible, more affordable. We do think AI has the potential to drive that next major shift. So there is something incredibly exciting and transformative afoot. I sincerely believe that. And that there are ways that AI can responsibly help users better reason, make decisions, take action to reduce some of the friction and cognitive load of managing money. And some of this is still not pipe dreams, but it's not yet real, but the vision is compelling, right? So for a consumer, this idea of, hey, I could have an AI agent that automatically sweeps my idle cash from my checking account to higher yield savings products, or that's continuously monitoring the market for debt refi opportunities. And when cheaper credit does become available, can help me take a lot of those steps to actually execute. I think for small businesses, this notion of like a CFO in your pocket, right? So agents that are reconciling payment transactions, they're helping you manage your books in real time. They're anticipating inventory needs. All of that is pretty darn exciting. So there's a lot here where I do think AI has tremendous potential. At the same time, I think to your observation, there's still a lot of noise and we're still early. We're still early both in making this real in practice and in sort of grappling with some of the related issues around bias and model drift and explainability and liability
Yeah.
and who's responsible. So lots of outstanding questions. And I think starting more incremental, which is to say, sort of with narrower permission tasks, where often humans are still in the loop somehow, and then slowly expanding autonomy as the trust, reliability, and frameworks come into place. But I do think done well, it could make financial services more proactive and personalized and help folks with the least margin for error today.
Yeah, exactly. And everything that you mentioned about explainability, accountability, transparency, liability, and so on and so forth, it looks like it's within the responsible AI principles, but then it's really important when a corporation or a fintech or a financial services firm is trying to de-risk its own strategy and investments, including private markets like yourself. These are key components. So it's nothing to do with financial inclusion or responsible AI, rather, it's just making good business sense, right? So
Right.
AI, more transparent and also traceable is really important, right? So yeah, couldn't agree more. I've been trying to talk about that quite a lot also. So don't keep responsible AI separate from financial services, because the concepts you are telling, it's still the same, just a different name to that.
Right. It's future proofing to
Yeah.
integrate some of that risk anticipation.
Exactly, exactly. So the earlier comment you made, right? So even though the growth is a little bit slower in the short term compared to your competition, you're building a very resilient infrastructure and foundation that's going to, little bit outlast some of the crisis that may potentially be, coming or you're already there. We don't know, right?
Yeah.
Yeah. Couldn't agree more. Now, for founders and professionals trying to enter fintech or venture, especially outside traditional networks, someone doesn't have the traditional pathway. So, what's the most practical journey for them if they want to start today?
Yeah. I think one of the encouraging things about fintech today is the barriers to entry are lower than they were historically. Um,
Mm,
and you don't need to come from a handful of traditional hubs or sort of a very specific background to build credibility and relationships in the ecosystem. So, in terms of practical advice, for founders, and this won't surprise you based on the conversation we had before, I think spending time deeply understanding a real customer pain point,
mhm.
where financial services are still broken or fragmented or expensive, like the best founders start with that lived experience and problem rather than a technology led thesis. Um, and I think for people trying to break into venture, there are a lot of new channels for sharing your point of view, and thoughtfully sort of getting your research or writing or market maps or product analysis out there and putting it on LinkedIn, on your social media channels of choice, I think can be a really effective way to share with folks your thinking and catch their attention and provoke engagement. Um, but across the board, sort of being curious, being persistent, being collaborative, all of those attributes pay dividends over time, regardless of how you express them.
Yeah, exactly. And sometimes I've seen when people want to get into venture, they're constantly trying to meet investors and try to pitch. But if you have something that you're already sharing as thought leadership or investment thesis or analysis of certain things, then probably you have an edge over someone else who's just trying to have a discussion, right?
Right.
Yeah.
Prepared mind, totally.
Yeah, we kind of coming up time, and I know we can keep going on forever, but is there anything else you'd like to share with our audience before we wrap up?
No, it's been such a pleasure spending the time with you. So thank you very much for all the thoughtful questions and for the opportunity to engage with your broader audience, and appreciate all the work and leadership you do in this space.
Thanks a lot, Sarah. And how can people get in touch with you? Is LinkedIn the best way, or what would be the right approach for people to
Yeah,
connect with
absolutely.
you?
They can email me directly at Sarah, Sarah, at flourishventures.com. That's one way. Or reach out to me on LinkedIn. Again, my name is Sarah Morgenstern. So either channel would be great, and I'd love to hear from folks.
Thanks so much for taking time, and I look forward to keeping in touch. Thank you.
Thank you very much. You too.